One is, as I mentioned before, the tax implications of debt settlement. As you saw, and as I mentioned in one of my earlier settlement agreements, which I saw in my settlement agreement at the same time, the IRS, the Internal Revenue Service of the United States, treats written off debt as income, which means if you have a $50,000 credit card account that you settle for $15,000, the next year during tax season, that bank that you settled that account with will send you a 1099-C reporting $35,000, the amount written off, or sometimes called forgiven, to the IRS, which you will have to report on your taxes as income. A lot of people hear just that and immediately flush with new emotions. What? Now I'm not just going to owe money to my banks, I'm going to owe money to the IRS. I don't have that money. And as always, that rush of new emotion comes from a lack of information. To begin with, that doesn't mean you're going to owe $35,000 in tax. That just becomes your new income basis for tax. So running those numbers, as we always do, if that's all the income you've earned that year, after some standard deductions, maybe a child tax credit if you have children and that applies, that $35,000 in gross income might be reduced to, say, $25,000 in net income. These are very rough guesstimates of what your taxes will be, of course, but based on that $25,000 in net income, if that puts you into the 10% tax bracket, it means you would owe $2,500 in tax. So for a $50,000 credit card account that you settled for $15,000 and had $35,000 in principal written off or forgiven and saved maybe another $50,000 in interest that you would have paid over the next 10 or 20 years making the minimum payment, $2,500 to the IRS doesn't seem too bad. So right there, that should alleviate some of the stress that goes with, oh my God, I'm going to have a big tax basis, that the written off portion isn't what you owe in tax. You'll just owe a small percentage of that based on whatever your tax bracket is in tax. But wait, there's more. The IRS also has something that's colloquially called the insolvency rule, which you must talk to an accountant about. So in very rough layman's terms, the insolvency rule says that if you are insolvent, meaning if your debts are higher than your assets at the time of debt settlement, that the tax liability on the forgiven debt can be waived. Now, there's a formula for that. It's a percentage of what your debts are and what your assets are and how much your insolvency is calculated to determine how much of the tax liability can be waived. I don't know that formula, so go talk to your accountant for sure about how the insolvency rule might apply to you. I can say that it applied in much of my debt settlement where I wound up owing very little in tax liability, even after having $150,000 in debt forgiven. That said, go talk to your accountant now in advance about all of this. If you can, have them run the numbers of what your tax returns might look like based on how much debt you intend to settle. The more information you can have in advance to prepare you for your debt settlement journey, the better. If your accountant runs out all of the numbers and says, hey, based on settling this amount, you might be liable for this much tax, but if you're this much insolvent at the time, it will only be this much tax, you can add that amount to your settlement target fund as something that you need to raise money for so that you're not surprised by it when it comes, which is why I wanted to include this section here. In my experience, the tax liability is a good business choice. But as part of being a good business choice by the numbers, something you want to know in advance and be prepared for. And just imagine how excited your accountant's going to be when you come in for this meeting to talk about what debt settlement could look like for you financially with a banker's box filled with files and your settlement target spreadsheet and all of your ideas, your income, debts, expenses, assets, and that savings that you're going for, prepared to talk to him or her in detail about what your actual financial life looks like to do it. Not only will it make them shocked, I'm sure, but have a lot less time that they need to spend on your account, which will save you money. But wait, there's even more. Even if you do wind up owing some tax liability to the IRS after settling out debt, you don't need to pay it right away. The IRS actually has very favorable structured installment plans that allow you, sometimes within a few constraints, to pick the payment that you feel comfortable sending in each month, usually at a very low interest rate, certainly much much lower than what a credit card would be charging you, so that you may be able to pay off that tax liability over years at a very comfortable payment amount that isn't stressing your life the way a credit card payment was, at a very comfortable interest rate that isn't costing you all of that money. Overall, I wanted you to know about the tax liabilities so that you can prepare for it and know that it is something that is not too difficult to overcome as long as you look at the numbers in advance like any CEO would around their taxes and make it part of your plan.